PantheonAI presents Johnson & Johnson rally, Ford recall, Bitcoin and Ethereum show resilience. Good morning, everyone, and welcome to the PAI Morning Briefing. I'm John, your host from PantheonAI, and it's July 16th, 2025. So glad you're tuning in.
And I'm Sarah. We're really excited to unpack the latest market moves with you today, dive deep into some major trends, and explore a series of intriguing news stories that are truly shaping the financial landscape. So grab that coffee or tea, settle in, and let's get started on our journey through the markets.
Absolutely. Let's kick things off with a quick market overview, shall we? The S&P 500 is currently trading at roughly 6,243.75, which is down about 0.8%. The Dow Jones is at around 44,023, reflecting a decline close to 1%.
So a bit of red across the board for the major indices. How are the tech stocks doing, John?
Good question, Sarah. Over in the tech arena, the Nasdaq lags slightly at about 20,678, down approximately 0.7%. But the Russell 2000, our small cap indicator, remains the laggard of the lot with a drop near 2.2%. That's quite a difference, isn't it?
It really is. And what about crypto? I know a lot of our listeners are always keen on that.
Well, on the crypto front, Bitcoin has been holding its own at roughly 118,773, actually up just a hair, almost 0.8%. And Ethereum is also riding a small wave of positivity, priced at about 3,176 and up by a bit more than 1%. So a bit of a mixed bag there compared to the traditional markets.
That's interesting. I mean, these percentages might seem minuscule when you look at them individually, but collectively, they really do remind us that the market remains in a state of cautious recalibration. Wouldn't you agree?
Oh, absolutely. That's a perfect way to put it, Sarah. And that actually transitions us nicely into our deeper dive on major market trends. There's a palpable undercurrent of investor caution that we've seen across multiple asset classes. It appears a mix of global uncertainties, geopolitical tensions, and ongoing macroeconomic adjustments is causing this ripple of volatility.
Right. And there's a consensus among many market observers that while short-term jitters aren't unusual, we might be at the cusp of a broader reassessment of risk. It's like you mentioned, John, large cap indexes like the S&P 500 and the Dow are showing modest declines, but smaller indexes, particularly the Russell 2000, are feeling the pinch even more severely. This divergence, it can sometimes point to a rotation out of riskier, smaller names as investors seek refuge in steadier blue-chip stocks.
That's a great point. Meanwhile, in the fast-evolving world of digital assets, Bitcoin and Ethereum seem to be sailing through these choppy waters with a slight uptick. The big question, of course, is this a sign that investors see these assets as safe havens, or could it simply be more volatility brewing under the surface? It's a debate that's sure to continue on trading floors in the coming sessions.
Definitely. It's never dull in crypto, that's for sure. But now, let's turn our attention to a comprehensive exploration of some of today's most important news stories, each carrying its own microcosm of market implications and sector-specific insights.
All right, kicking us off, our first story hails from the pharmaceutical and healthcare arena. Johnson & Johnson stock rallied today after the healthcare giant reported earnings that beat analysts' expectations. Even more intriguing was the raised full-year outlook they announced, which provided a much-needed lift to broader pharma stocks.
And this isn't just any earnings beat, John. It's a strong signal that the company's diversification strategy and robust pipeline of products are really resonating in the marketplace. For investors, this could be a reminder to keep an eye on quality healthcare stocks, as they continue to offer a cushion against the volatility we're seeing in other sectors.
Absolutely. Now, on a different note, the automotive sector is feeling a bit of a bump in the road. Ford stock, as some of you might have noticed, took a hit after the company disclosed the expected cost of a large-scale recall of its SUVs. Specifically, Ford admitted it would likely spend nearly $600,000 to fix fuel injectors on up to nearly 700,000 vehicles.
Wow. I mean, in the grand scheme, while recalls are almost an unavoidable footprint in the automotive industry's evolution, this really serves as yet another reminder that operations, safety, and quality control are under the microscope, especially when production standards are put to the test.
Indeed. Meanwhile, in the bustling arena of digital asset management, Nasdaq-listed VCI Global is making headlines with a significant strategic move. They're in the process of acquiring a licensed fund manager based in Malaysia's Labuan jurisdiction.
And the purpose? to launch what promises to be a fully regulated Bitcoin fund aimed at providing institutional exposure to digital assets. This is a bold step, and it marks yet another milestone in the ongoing evolution of the cryptocurrency market, bridging the gap between traditional financial structures and new-age digital assets. One might say that if your portfolio had a "bring your digital assets to work" day, today would be it.
I love that analogy, Sarah. Switching gears to the energy sector, SLB has recently closed its acquisition of ChampionX. Under the terms of this strategic move, ChampionX shareholders received roughly 0.735 shares of SLB common stock for each share they owned. This type of acquisition isn't entirely new in the energy landscape, yet it speaks volumes about consolidation strategies in an industry navigating both transitional energy policies and fluctuating global oil prices.
Right. Energy companies, it appears, are continuously seeking ways to streamline operations and capitalize on synergies amid an ever-changing market dynamic. It makes sense, given the current environment.
Absolutely. And another intriguing development, we have a story featuring short seller Jim Chanos, who has found himself in the spotlight once again. This time, he's taking a critical look at MicroStrategy's premium in relation to the Bitcoin it holds, engaging in a verbal duel of sorts with a prominent Bitcoin evangelist.
Jim Chanos, who made his name by shorting shares back during the Enron era, is known for his prescient market insights and often contrarian positions. His latest foray into debating the valuation and premium surrounding digital assets found in MicroStrategy's balance sheet really brings to light an ongoing debate. Are we witnessing a bubble in the crypto premium, or is it simply reflective of a new form of digital gold? It's a head-to-head that not only stokes investor curiosity, but also challenges long-held assumptions about market valuation in the digital era.
That's a fascinating debate. Turning our attention to Europe, German Finance Minister Klingbeil is weighing in on broader economic matters with a somewhat optimistic outlook for the second half of the year. Citing external factors such as Trump tariffs and the inherent flexibility within EU fiscal rules, the German Finance Minister expressed expectations for economic recovery and growth across the region.
This comes at a time when many global investors are keenly watching how policy shifts in one part of the world can ripple out to affect currencies, interest rates, and capital flows elsewhere. If Germany's forecast bears fruit, it could really reinvigorate investor sentiment across European markets, possibly making it a case study in resilience amid external headwinds.
A very important point, Sarah. Back across the Atlantic, Bank of America is capturing attention by profiting from what it calls U.S. consumer resilience, even as tariff jitters continue to loom over trade disputes. The bank, maintaining its financial outlook for the year, has been vocal about the continued strength of the American consumer, a factor that many argue reinforces the stability of domestic markets.
This story really serves to remind us all that, even in the face of international trade disputes and tariff-related challenges, the underlying fundamentals of consumer behavior can act as a sturdy bulwark for economic activity. It's good to see that resilience.
It really is. And in a rather unexpected twist, wholesale prices remained flat in June, according to the latest producer price index, suggesting that U.S. tariffs have had only a muted effect on inflation thus far. This is a welcome piece of news for many, as it casts a slightly more optimistic light on the inflation picture.
Yeah, in a time when concerns about a tariff-induced surge in consumer prices have been a topic of daily debate, this stable reading might help restore some confidence among businesses and consumers alike. That's a relief.
Definitely. Another thought-provoking piece centers on the perennial debate about the U.S. dollar's standing as the globally preferred safe haven. There's been robust discussion around whether the dollar can reclaim or maintain its A-list status amid emerging economic policies and geopolitical tensions.
As tariffs and trade wars continue to challenge the conventional theories of currency dominance, this question remains open for discussion. Could a shift in global economic fundamentals pave the way for a reevaluation of the dollar's role? It's an open question that invites investors to think twice about currency exposure in a world that is ever dynamic.
It truly is. Lastly, we must touch upon the world of corporate mergers and breakups. A recent narrative suggests that while mergers often lead to massive wealth destruction, breakups can ironically create wealth opportunities for the savvy investor. A well-known example floating around the halls of Wall Street involves rumors of a potential split at Kraft Heinz.
This might sound counterintuitive, but history tells us that when conglomerates or highly integrated companies decide to unwind their operations, the resulting segmentation can unlock hidden value. As mergers and acquisitions continue to shape corporate strategies, it prompts us to ask, are we in a period where less is more? It's a question that reverberates through investment strategies and corporate boardrooms alike.
That's a profound thought, Sarah. Now that we've covered these important stories, let's dive into some detailed sector analysis. In the technology space, we continue to see investors weighing the performance of tech giants against the backdrop of slowing growth and increasing regulatory scrutiny. The Nasdaq's slight decline today, while not dramatic on its own, is indicative of a broader hesitation among investors to commit heavily in the sector.
It really highlights the balancing act that market participants face. On one hand, there's the lure of innovation and rapid growth. On the other, the prudent need to manage risk in a volatile regulatory environment. I like to joke that sometimes tech charts seem to have as many ups and downs as a roller coaster in an amusement park. And yet, here we are, strapped in for the ride.
That's a great analogy. Moving over to the energy sector, the acquisition of ChampionX by SLB signals a consolidation trend that many analysts believe is geared towards streamlining operations amid fluctuating oil prices. The energy market has been in a state of flux for a while now, grappling with global saturation, regulatory changes, and the increasing push towards renewable energy sources.
Yeah, and today's consolidation move may indicate that major players are seeking stability through strategic acquisitions, which could ultimately lead to greater efficiency in an otherwise turbulent market. For those of you with exposure to energy stocks, it might be time to consider how these mergers could translate into long-term operational synergies, and perhaps a little relief from those quarterly earnings surprises.
Good point. In the financial sector, the story of Bank of America and the discussion surrounding tariff jitters deserves special mention. The bank's reassuring financial outlook, bolstered by a resilient American consumer base, adds another layer of complexity to the narrative. At this moment, we witness market forces that remind us that even amidst diplomatic tensions and tariff uncertainties, consumer demand often serves as an unyielding engine of growth.
It raises an interesting point. Can traditional financial institutions continue to serve as the anchoring points for an evolved economic landscape? There's no doubt that their role will remain pivotal in maintaining market stability, yet they too must innovate and adapt to an era defined by rapid technological change and global interdependencies.
Definitely. Pharmaceutical stocks have once again come into the limelight thanks to Johnson & Johnson's earnings beat and the subsequent uplift in their full-year outlook. The healthcare sector has always stood out as a relatively resilient piece of the economic puzzle, providing faster-than-average growth in times of economic stress.
And with regulatory support and constant innovation in treatment modalities, pharma stocks are often considered a bedrock of defensive investing. As we digest today's news, it's a pertinent reminder to stay vigilant about advancements in biotech and medical research, as these have the potential to drive significant long-term gains.
Absolutely. Of course, we cannot ignore the ever-evolving narrative in digital assets, with VCI Global taking a bold leap into launching a regulated Bitcoin fund, and the ensuing debate sparked by figures like Jim Chanos. The digital currency realm is anything but predictable.
The very nature of this space is defined by rapid innovation, shifting regulatory landscapes, and an appetite for risk that borders on the adventurous. As institutional interest in digital assets grows, it becomes vital to assess not just the standalone risks of each cryptocurrency, but also the broader implications for portfolio diversification and long-term value creation.
That's a crucial point. Taking a global perspective, there's plenty happening off our shores that demands attention. German Finance Minister Klingbeil's optimistic forecast serves as a reminder that Europe, often seen as a bellwether for cautious and measured growth, might be poised for a rebound in the latter half of the year.
The interplay between American trade policies and European fiscal flexibility is a narrative that has international ramifications. European stability, after all, has a way of influencing global capital flows, currency valuations, and even investor sentiment in emerging markets. It's an intricate dance, one that challenges even the most seasoned market participants to keep a finger on the global pulse.
So, what can we take away from these unfolding market dynamics and news stories? Let's run through a few key points together. First, while major indexes like the S&P 500, Dow Jones, and Nasdaq are showing modest declines, the small-cap segment, represented by the Russell 2000, is facing tougher winds. This divergence suggests that investors may be reallocating their capital in favor of larger, more established companies during these uncertain times.
And second, the positive performance of digital assets signals that, even amidst traditional market challenges, there remain pockets of optimism and growth in alternative asset classes. It's not all doom and gloom.
Right. And third, sector-specific news, from pharma to automotive and tech to energy, underscores the importance of diversification in one's portfolio. You just can't put all your eggs in one basket.
Beyond the hard numbers and headlines, there's a lesson in resilience and adaptation that we can all apply to our investment strategies. Markets by nature are ever-changing, and a story that seems challenging today might be the one that drives innovative breakthroughs tomorrow. This delicate balance of risk and reward is precisely what makes investing both a science and an art.
I like to think of it as similar to cooking a complex meal. You need just the right mixture of ingredients, timing, and a dash of intuition to create something truly memorable. So true. Now, turning to some expert insights and predictions for the near future, it seems that many analysts are forecasting continued volatility in the short term, driven by global macroeconomic uncertainties and shifting fiscal policies.
However, there's also a burgeoning optimism for sectors that are aligned with technological innovation and sustainable growth. The increased regulatory clarity around digital assets, as evidenced by moves like VCI Global's acquisition, may pave the way for broader institutional adoption, provided investors are willing to ride out the inherent ups and downs of nascent markets.
In our discussions with industry experts over the past few days, one recurring theme has been the importance of staying nimble and adaptive. Whether you're a trader with a penchant for capturing short-term anomalies or a long-term investor seeking steady growth, the consensus is clear. Knowledge and agility are your greatest assets.
Think about it. If stock charts had mood rings, many of today's companies would be flashing a spectrum of colors, from cautionary red to hopeful green. That's the reality of a market in flux, and it invites each of us to ask ourselves, how prepared am I to adapt to a rapidly evolving economic landscape?
That's a great question to ponder. Let's also consider some thought-provoking questions for you, our valued listeners. Have you evaluated how your portfolio might hedge against potential downturns in the small-cap segment if this trend continues?
And with the international stage playing host to renewed economic optimism, are you positioning yourself to take advantage of diversified exposure in both traditional and alternative assets?
And lastly, in a world where mergers sometimes unlock hidden value and at other times lead to wealth destruction, how do you discern when a corporate breakup might actually be an opportunity in disguise?
Before we wrap up our briefing for today, I want to share a few reflective insights regarding the sectors we discussed. In the tech world, the tension between innovation and regulatory oversight is prompting companies to re-examine their roadmaps. Investors must remember that while technological advancements can drive exponential returns, they often come paired with elevated risk.
And in energy, the consolidation trends underscore a broader narrative of adapting to renewed pressure from global sustainability initiatives. Financial institutions, meanwhile, are showcasing that while tariff jitters may unsettle markets momentarily, the enduring strength of consumer spending often serves as the stabilizing force that guides overall economic progress.
On the global front, with regions like Europe potentially leading a rebound thanks to measured fiscal policies and targeted growth forecasts, there lies an opportunity for international diversification. For those of you with a keen interest in cross-border investments, the interplay between American policy shifts and European economic recovery is deserving of close attention.
After all, in today's interconnected markets, developments in one region can have far-reaching implications that influence everything from local consumer confidence to global equity valuations. It's truly a global village when it comes to markets.
It really is, and as we look ahead, it becomes increasingly important to keep your investment strategies flexible. Whether it's a sector-specific adjustment, like rebalancing exposure to tech or energy, or a more comprehensive review of your portfolio's diversification, adapting to change remains paramount. The investment landscape, as we all know, is a continuously moving target, and sometimes the best strategy is one that anticipates change rather than reacting to it.
That's a fantastic point to end on, Sarah. As we bring this extensive discussion to a natural close, I want to emphasize a few key takeaways. First, the broad declines in U.S. indexes alongside relative stability in digital asset prices highlight a dual narrative of caution and cautious optimism across different asset classes.
Second, significant stories. From Johnson & Johnson's robust earnings beat to Ford's hit by recall expenses, from strategic acquisitions in the energy sector to bold moves in digital asset management, underscore the diverse challenges and opportunities that exist in the market today.
And third, The global implications of local policies, be it through German Finance Minister Klingbeil's anticipated economic growth or the broader implications of U.S. tariff policies, demand a keen eye on international developments. It's all connected.
Absolutely. Now, I'd like to give a big shout out to PantheonAI, your trusted information co-pilot. Our mission is to make complex market information accessible, engaging, and above all, actionable for you. As you reflect on today's briefing, I encourage you to ask yourself, what trends will directly impact your trades tomorrow? How might the interplay between traditional and digital assets reshape your portfolio strategy? And, most importantly, how agile are you prepared to be in the face of a market that can change its tune faster than a chameleon on a rainbow?
I also want to remind you that our conversation doesn't end here. We invite you to come back for the next episode tomorrow, when we'll dive into even more fresh insights, expert opinions, and market predictions that might just change the way you view your investments. And if you ever have questions, remember, our AI co-pilot is always on hand to guide you through the complexities of the market.
Before we sign off, let's end on a light note. I once joked that my portfolio sometimes looks like a suspense thriller, with twists and turns that keep you on the edge of your seat. And while I may be laughing now, rest assured that these unpredictabilities are what make the market so fascinating and dynamic. After all, if the stock market were a straight road, it would be a pretty dull ride indeed.
That's so true, Sarah. To everyone listening, thank you for joining us on this in-depth exploration of today's financial landscape. Stay curious, stay informed, and always keep an eye out for those subtle shifts in market momentum. Remember, each piece of news, each market statistic, each corporate decision offers not merely numbers on a screen, but insights into the broader economic narrative that shapes our lives.
Learning shouldn't feel like a full-time job. Until tomorrow, this has been Sarah and John, your hosts from PantheonAI, signing off. Take care and keep navigating those interesting market dynamics with confidence and curiosity. PantheonAI, your information co-pilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.